I put out a video recently where I said, study wealth, not politics. And I had a subscriber comment and said, everything is politics. You know, even money and wealth itself can't exist unless politics allows it to exist. Just look at the dollar bill. There's heads of state on it. Now, there's a couple things I disagree with there, like, for example, Bitcoin does not have a head of state on it, but that's not the topic of today's video. Today, we are going to talk about the conflict in Iran and Israel, which is clearly a political topic. The point I was making in that previous video is that we should not look at political events and start to think about right versus left and conservative versus liberal and all this stuff. That is a waste of time, and at the end of the day, it's going to get you upset and pissed off, and it's going to ruin your day, quite frankly. Instead, what I recommend and what I try to share with you on this channel is, here is an event that is happening in the world, and here's what you can do about it to maintain your wealth and grow your wealth. So that is what we are doing today. We are going to look at the war in Iran and Israel, not from a political lens of who's right and who's wrong. War is terrible. We can all agree on that. But what we're going to look at is, how did markets respond? We're going to look at the US dollar, gold, oil, the stock market, and Bitcoin. Why are we doing this? Well, one, we want to understand how our investments are performing through a crisis like this. But more importantly, I want to use this event as an example to teach you about how investments generally perform so that you can be more prepared in the future if another event happens and you are worried about your investments. Because, spoiler alert, you do not want to be panic selling, and you don't want to be panic buying either. First, we're going to cover each of these asset classes and how they performed through this crisis. And we're going to talk about why you shouldn't be panic buying or panic selling during moments like this. Then we're going to talk about a very important concept in investing called priced in, and why events like this often don't have the predictable outcome on your investments like you think they might, which is also why you don't want to try to time the market. And last but not least, I'll be sharing what I am doing with my investments and a quick little bonus for my longtime followers. So stay tuned for that. Without further ado, let's dive in. What's up, everyone? This is Brandon from Wealth Potion, where we discussed personal finance, wealth creation, investing, and business in a fun and easy and simple way, because I genuinely believe that we should have learned all of this stuff in school, but we didn't. Luckily, I was able to learn these things from mentors, through trial and error, from hundreds of hours of research in some very, very niche topics. And I was able to build my wealth to a point where I'm able to quit my full-time job, move across the world, and live the life and freedom that I've always wanted. And I want to share that all with you in short 10 to 15 minute videos and through my free newsletter that goes out once a week. And today's video is no different, and we're tackling a very important topic, which is, what should we do when there's a big news headline like a potential world war? If you haven't been following the story in the Middle East in depth, don't worry, I'm going to provide a really quick recap so we're all on the same page. And importantly, we want to understand the dates at which this conflict spiked and when it started to calm down, because we're going to look at those dates when we look at our investments and how they responded. So here's a quick recap. On June 13th, Israel launched a surprise airstrike into Iran. And now, to be clear, I'm not making a claim that Israel is the one that started this whole thing. There's a whole bunch of historical background that is irrelevant right now. What's important is that June 13th is when this conflict really sparked and became a bigger conflict. On June 19th, Iran retaliated and sent missiles back into Israel. On June 22nd, the United States got involved and also sent missiles and bombs into Iran. And the next important date is June 23rd, because this is when Trump claims that there has been a ceasefire in the region and the conflict has calmed down. Now, I'm recording this on the 26th. Things could have been happening in these past few days that we haven't heard from. Things will likely continue to happen over the course of this week by the time you're watching this video. The point is, there are two very important dates for us to look at. June 13th, when the conflict escalated, and June 24th, when the conflict calmed down. All right, so how did the markets react? We're gonna start at a very basic level by looking at the US dollar and gold. And the reason for this is because we wanna talk about a concept called a flight to safety. When a conflict happens in the world, generally, en masse, if we look at the market on average, is that investors will move from riskier assets to safer assets. And this is often referred to as a flight to safety. The US dollar is considered a very safe asset because the US dollar is, relatively speaking, the safest fiat currency. As we've touched on in the past, the US dollar is also the world's reserve currency, meaning that it's the currency that is used the most in global trade. To put it another way, it means that all countries in the world have some incentive to make sure the US dollar stays stable. So to put it really simply, when some crisis breaks out, typically investors will sell assets for dollars. And if we look at the chart, this is exactly what happened. You can see that the US dollar, as measured by the Dixie index, which is basically the price of the US dollar compared to other currencies, you can see that it spiked, meaning that investors were moving from other assets into the US dollar. Fast forward to June 24th, and we noticed that when the crisis calmed down, people moved out of the US dollar. Presumably, they moved those dollars back into risky assets like the stock market. And we can corroborate this by now looking at gold. Gold is also a historical flight to safety. Prior to the existing monetary agreement where we have fiat currency that isn't really tied to anything, for a very, very long time, dollars, in particular US dollars, were tied to gold. And at a certain point in time, if you ask your grandparents, they could take US dollars, bring them to the bank, and exchange it for an appropriate amount of gold. That was what was called the gold standard. And so because of this historicity, because gold is a scarce resource that you can't just print more of, gold is considered a safe haven asset. So again, we look at the chart for gold, we notice that when the crisis broke out, the price of gold spiked. And it actually almost hit all-time highs for gold. Then on the 24th, when the crisis calmed down, gold lost basically all of its gains and is back to a much more normal pre-crisis level. And that brings us to our first takeaway, which is there is a very real phenomenon called a flight to safety. However, the reason you don't want to panic sell or panic buy is that these movements on these charts are happening within minutes. And so unless you are a Wall Street investor and you are right in front of a trading terminal and you see the news headlines and you're able to make an action within minutes, if you saw the war headlines and then you went to go buy gold, you would have been buying it at the top because you wouldn't have been as fast as the algorithms and machines that are on Wall Street making these purchases immediately. And then when the crisis calms down and you go to sell your gold because you're like, okay, the crisis is over, you would be getting the price down at the bottom. You would be buying high and selling low. So the moral of the story is do not panic sell or panic buy assets when there's a news headline, because you are not going to beat Wall Street and their extremely fast computers that can make these trades practically instantly. By the way, if you're enjoying this video so far, firstly, thank you. And secondly, I want to let you know that soon I will be releasing the Wealth Potion Quest Log, which is a free resource that you can use to build your wealth step by step. Just like in a video game, when you have a quest log of things to do, I wanted to provide a very real guide that anyone can use to build their wealth, starting at the very basics of getting rid of debt and saving in cash, all the way to buying your first home and retiring early if that's something that you want to do. So if you're interested, in the description and in the comments, there will be a link. All you have to do is sign up for the newsletter. My newsletter subscribers will be the first to know. And by the way, I'm going to continue building on this guide and it might not stay free forever. So if you want to get access now, just sign up with your email and I'll see you on the inside. Now let's shift gears and look at some more complicated asset classes. First, let's look at oil. And oil is a unique asset for a lot of reasons. I mean, one, we're talking about a conflict in the Middle East, and the Middle East is a very large supplier of oil to the rest of the world. And so in this particular scenario, oil is impacted by this crisis. But if there was a geopolitical crisis in Europe or in China or in the Arctic, it's not going to have the impact on oil. However, it is important to note why politics, particularly geopolitics, is important to investors, because when a crisis breaks out, it has a very real impact. To put it really simply, when there's a conflict in the Middle East, Middle Eastern countries may stop exporting oil, which will increase the price of oil. And that is exactly what happened. If you look at the price of oil, we can see that there was a massive spike when those missiles hit Iran on June 13th. And similarly, when the crisis was calming down, we can see that the price of oil dropped again. And this is where I want to talk about a very important concept called pricing in, or being priced in. This is something that if there's interest, let me know in the comments. I'm happy to do a dedicated video on it because it is a very important but nuanced topic. Investors all around the world are constantly assessing various risks before they've even happened. And when they do that, they are then taking the probability of those risks happening and then investing accordingly. If there's a whole bunch of tension in the Middle East, even without missile strikes, there is a higher probability of a conflict breaking out. You will notice the price of something like oil rise in anticipation of that risk. That is what is called being priced in. The event hasn't happened yet, but it is being reflected in the price of that asset. And the reason I point this out is important to understand how fast markets moved. The moment those missiles from Israel hit Iran, it didn't actually prevent tankers from moving oil from the oil sands out to other countries, but the price of oil immediately changed, despite the oil markets having not changed yet. And that is an example of something being priced in. Conflict breaks out, the price moves instantly because investors are reassessing that risk. Oil investors realize, hey, there's a much higher risk of the oil markets becoming distressed. The oil price will likely go up, so we're gonna buy, and the price of oil then goes up. Again, goes back to our earlier point, why you do not want to be trying to time the market, because you are not going to beat Wall Street in terms of how quick they can act on these things. Again, this was a very simple overview of what it means to be priced in. If you'd like me to do a dedicated video on it, let me know in the comments, and subscribe to the channel if you're learning something, and I'd love to hear your feedback either way. All right, so we've covered the US dollar, we've covered gold, and now we've covered oil. Now let's get into the meat and potatoes, probably what you are invested in if you've started investing your money, and that is the stock market. How did the stock market respond to the crisis? And this is an interesting one. If we look at the chart, there was a strange V shape that happened the day of the strikes. The stock market quickly dipped and then quickly recovered. And throughout the crisis, you can see the stock market has stayed pretty resilient. It hasn't really swung up or down, obviously with some volatility here and there. And then when the ceasefire was announced, the S&P 500 rocketed back to almost all-time highs. There's a couple interesting lessons here. One, to reinforce what we said earlier. You don't want to be panic buying or panic selling, because looking at this chart, there is no clear reaction that the S&P 500 is making, and if you panic sold, you're now worse off. Secondly, this is an interesting example of something being priced in. One possible explanation for why the stock market didn't move that much on June 13th is because the conflict in the Middle East was already fully priced in. Investors were already considering significant risk in that region, and the price was already reflecting that risk. And so when the actual event happened, there was a bit of a flash because there was some activity, but nothing really changed in terms of the price of the S&P 500. Now, of course, the other thing to keep in mind is the S&P 500 is an amalgam of stocks. It's 500 different companies. So a lot of things could have been happening outside of the conflict in the Middle East that could impact the price of these stocks. And so it's not as simple as something like oil, where conflict happens and the price of oil reacts. The S&P 500 is simply more complex. And that is really the third lesson here, which is there are so many factors that drive the price of things, especially an asset class like the stock market. And this is why even hedge funds on Wall Street aren't able to outperform the S&P 500. So if you think you can actively trade and you can buy low and sell high, you might get lucky a few times, but the best investors on Wall Street still aren't performing a buy and hold passive investment strategy. Last but not least, we have to talk about Bitcoin, because during these crises, it often reignites this debate in the finance world, which is Bitcoin a risk hedge? Like, is it digital gold, or is it a risk asset like a tech stock? And I've done a whole video on this if you want to check it out. The short answer is that it's a little bit of both. And if we look at how Bitcoin reacted, we can kind of see what I mean by that. If we look at the chart, Bitcoin responded in a very similar way to the S&P 500. It kind of did this weird V shape when the crisis broke out, and then it also recovered most of its loss towards the end when the crisis calmed down. And so looking at this crisis, you could make the argument that Bitcoin is actually a risk asset because it's basically trading like the S&P 500. However, if we zoom out and we look at Bitcoin's performance over the past year, we'll notice that Bitcoin has been rising steadily to new all-time highs, just like gold has. And gold, as we just covered, is a safe haven asset. And so this is why I say Bitcoin has some properties of a risk asset. It's extremely volatile and tends to do well when other risk assets do well, but it also is an inflation hedge. It is a digital gold in terms of its scarcity and how the government and corporations cannot print more of it. All that to say, I'm not here to shill you Bitcoin, but I do want you to understand it as an asset class, because a lot of people that aren't familiar with Bitcoin just think of it as crypto, this, magic internet money, but it has very interesting properties in the investment landscape. And it's also why I believe it's going to be a much bigger part of the investment landscape in the years to come. All right, that's it for today. I know it was a longer one, but to sum up the key takeaways here, I hope that you leave this video understanding a bit more about how the macro world environment affects your investments, why you shouldn't try to predict these things and panic buy and panic sell, and why when these things happen, the best thing to do is to stay calm. Stick with your existing investment strategy by buying and holding assets that you think will be valuable in the long run. If you watched this video all the way through, I appreciate you. If you enjoyed the content, if you learned something, would greatly appreciate you like this video and subscribe, or send it to a friend who would find this interesting or useful for their investment journey. Otherwise, I'll see you next time.